You've got a successful and profitable business. You're saving retained earnings into your holding company every year. The kids are good, you bought the house, and everything seems to be going fine. But you know what they say, more money, more problems. Now, it's how do I grow my retained earnings savings without it being subject to the highest tax bracket? How do I make sure I have liquidity for my business or for other investments that come up along the way? How do I pay for retirement without paying a massive amount in taxes? And at the end of it all, how do I transfer all of this to my family and loved ones to create that legacy without sending more than half of my money to Ottawa to do whatever they're going to do? If these are the problems that you're facing as a business owner in Canada, you're in the right place. Let me introduce you to a very specific financial concept called the Immediate Financing Arrangement, or IFA. So who is this for? Like I just said, right? This is a niche financial strategy that is only suitable for people in a very specific situation. If that's you in that specific situation, then the value of doing something like this could be hundreds of thousands or millions of dollars. So this strategy is great for people who need a large amount of permanent insurance for estate purposes, but don't want to tie up a large amount of capital inside a life insurance policy. Your company is profitable and you're flowing retained earnings from your operating company to your holding company every year. You've got a 6 or 7 or 8 figure annual cash flow. You're financially savvy and you have a good relationship with debt. And you've also got a large life insurance need now, and you will have a bigger life insurance need later when you eventually pass away. So today, that means you probably have young kids, possibly business partners, and probably some big debts like mortgages. And then in the future, this means that the assets you own now will have appreciated in value and you will have a large capital gain due on death. So this capital gain could be company shares, it could be a portfolio, it could be real estate, it could be other assets. Who is this not for? So if you're not profitable and flowing significant cash flow to your holding company each year on a consistent basis, then this is not a good idea for you. If you don't have a need for life insurance in the first place, also not a good idea for you. If you don't have kids or you don't have anyone to leave a large insurance legacy to when you pass away, also probably not a good idea for you. And then if you don't have a good relationship and a good handle on your debt, this is for sure not a good idea for you, because a large part of what makes this strategy work is the lending. So we'll start at the beginning. What is the IFA? Here we go. IFA is building up a large cash value inside a life insurance contract and then using that cash value as collateral for a loan with a third-party lender like a bank. And then we're usually holding that life insurance contract inside your holding company, and we're using the life insurance to store the retained earnings. The big benefit of wrapping up your money inside a life insurance contract is that the whole life insurance that we're using grows with a dividend from the insurance company's participating account. So you get safe, stable, and consistent growth of your money that's not tied to the ups and downs of the stock market. Another big benefit of wrapping up your retained earnings inside a life insurance contract is that the tax treatment of life insurance in Canada. Life insurance in Canada is considered tax exempt. The growth within the policy is tax deferred, and the life insurance payout at the end is tax free. So this is a way to grow your money in a tax efficient way, use your money in a tax efficient way while you're alive, and then pass down your money tax free when you die. There really aren't any other assets in Canada that let you do this in this way. Question I get all the time: why haven't I heard about this, right? I get this all the time. Sounds great, Laurent. Why have I never heard of this? Well, it's pretty simple. Only a very few people in Canada should ever be doing something like this. Statistics Canada says that there's 1.2 million businesses in Canada. If each one is owned by one person, and they're not, then about 3% of Canadians are business owners. Out of these 3%, StatsCan says 68% will survive the first 5 years. So we can assume that there's some sort of profitability there, and the ones that are gone are not profitable. So what I'm saying is, on a broad basis, only about 2% of Canadians would even be in a position to start considering this. Now add to that these business owners should also probably have kids, should have some sort of large capital gain on death, And they also need an affinity for life insurance and be comfortable with debt and alternative financial strategies. So basically, I'm saying there's not a lot of advertising for strategies that really only could potentially be suitable for 1% or less of the population. It's much more profitable for companies to advertise more mainstream strategies that are applicable to way more people. Only dummies like me take our whole company and focus it on a super niche and complex financial strategy that's only really relevant for less than 1% of the population. This is also why when you see other videos telling you not to use leveraged life insurance strategies, they're probably right. 99% of people shouldn't do this. But for the few people that fit this profile that I've been talking about, they're profitable business owner, they have a family, they have a need for life insurance, this strategy becomes a no-brainer. And it's one of the only things that you can do to grow, use, and pass on the money inside your holding company without a tremendous amount of it being sent to Ottawa in taxes. Now let's get into it. How does it work? If you're still here, congratulations being in the 1% of profitable business owners in the country. We're a rather small bunch. Here's the quick rundown of how one of these IFA systems works. First, you set up a participating whole life insurance policy with one of the few Canadian insurance companies who offer the right types of policies to do this. And then this is where we can help you. Now, how much do you set up? It depends on a few things. So first, we want to make sure you have the right amount of life insurance based on your company and family needs. Then, we want to look at the annual retained earnings that you're flowing to your holding company each year. We'll use these two numbers to determine the amount of life insurance you need and the amount of cash value that you want to put into the policy. We'll have a couple of meetings to make sure we dial this in right, and then the next step in the process is to actually apply for the insurance. Just because you want to set up a strategy like this doesn't mean you can. You have to apply for the insurance and you have to be approved. So while the insurance application is being underwritten, we simultaneously talk to the bank about setting up the lending against the proposed insurance. The bank lending is very specialized lending, and only a very few people inside the bank know how to do this and know how to set it up. You can't just walk into the branch and talk to the teller and get this set up, right? They'll have no idea what you're talking about. We're generally working with either private bankers or commercial bankers when we're setting up IFA lending. And then while we're doing this, we are also in communication with your accountant and with your lawyer to make sure that everybody's on board with the strategy and that they can provide the underwriting documents and the ongoing maintenance requirements every year. How long does this take to all set up? Well, it really depends, but it's going to be at least months and it could be years, depending on how organized your paperwork is. If your taxes are up to date, your health assessments, and that might involve going to go see your doctor. Personally, I just finished setting up another one of these for myself, and it took about a year to get everything done. And this is my job, right? I do this all day, every day. Once the insurance is set up and the bank credit is approved, everything goes much more quickly. The loan is generally a line of credit that you can access whenever you want after it's set up. And then when you borrow the money from the bank, there's obviously interest due, and the rates are favorable. They're usually around prime, prime minus, prime plus, depending on your credit situation and depending on the bank's risk assessment of you. Generally, our clients are doing interest-only payments on the loan, but you can do more if you want. In very simple terms, this is asset-based lending using a life insurance policy as the asset. It's very similar to if you used real estate or a stock portfolio as collateral for lending, just minus a lot of the market risk of the stock portfolio and the management and the work and the time of managing real estate. Something you need to know is that if the borrower defaults on the loan, so if you default on the loan, that lender or bank could collapse the life insurance policy to recover the loan amount. But banks generally don't want to do this. They will try to find a way to work with you. We deal with most of the major banks in Canada on this strategy, and the ones that I've asked about this, they say that collapsing the policy to recover loan proceeds is something they definitely don't want to do, and it's in the single digits of what they've done in the last 20 years. So now, what are the major advantages of setting something like this up? What are the major advantages of an IFA? First, you need the insurance anyway for your life and for your business. This is a way to get the large amount of insurance that you need while not tying up your money in big premiums. It's a way to grow the money inside your holding company without it being subject to high tax. And then because life insurance is tax exempt, your money growing in the policy also doesn't contribute to the new passive income rules that came into effect in 2018. And then through the loans that are set up at the bank, you get to keep liquidity for your company to use the funds for whatever you want. This is usually investing back into your company, maybe into the market or real estate, whatever you want to invest in. We have clients doing all sorts of things with their IFA structures. And then the life insurance death benefit is actually going to grow over time as well. And it's going to be there for you on death when you probably will have a huge capital gains bill due. And then the life insurance pays out tax-free to your corporation, creates what's called a capital dividend account, or CDA. What is a CDA? It's a tax account that tracks tax-free surplus inside a corporation. So usually this is created by a capital dividend, or it's created by life insurance proceeds. The CDA then pays out to your beneficiaries tax-free. So the insurance pays to the corp tax-free, creates the CDA, and then goes to your beneficiaries tax-free. Some major risks that you should definitely look out for, right? Everything I've talked about right here so far is happy, but there's also some major risks that come with setting up a strategy like this. So the first risk is that you're setting up a large annual premium commitment to fund the life insurance policy. So you shouldn't get into something like this without the certainty of having those annual premium deposits each year, or a big lump sum right now that we can use to fund the policy. There's also a commitment risk. We're using a whole life insurance policy in this case to build up your cash value as that asset that's going to secure your lending. As the name suggests, the insurance is for your whole life. So this is a strategy that you're setting up for maybe 30 or 40 or 50 years. It's not a short-term strategy that you set up and cancel. You're literally setting this thing up for the rest of your life. Some people like me really like it, and then other people don't like that long-term commitment. And if you don't like long-term commitment on your financials, this is a strategy you do not want to do. Please. There's also interest rate risk. So because, in order to use the liquidity that you're borrowing from the bank, there's interest payable. And as you borrow more and more each year, the loan is getting bigger and your interest payments are growing. Because you're borrowing, changing interest rates will also affect this strategy. So we know what interest rates are today, but we don't know what they're going to be tomorrow or next year or 5 years or 10 years down the line. What we do know is that interest rates are going to change. There's also potentially tax implications. So while the loan itself is not taxable, there could be tax consequences if you cancel the policy or if your policy lapses, which we totally don't suggest you do. There is also annual maintenance that you need to do on the actual life insurance policy, on your taxes, and on your banking. So you need to work with somebody who knows how to do this and who can be there to facilitate this every year for you. You don't want to set this up with somebody who isn't going to be there for you every single year to do the maintenance on these policy, because there is some paperwork that needs to happen. And we've had this happen where people have gone to other advisors who think that they can do this, and then they set it up, and then that advisor disappears, which is a huge problem. You need to work with somebody who's going to be there next year and next year and next year and 5 years. So like I just said before, this strategy is probably only good for about 1% of Canadians. In that same vein, only about 1% of financial advisors should be talking about and implementing this strategy for you. It's very, very important that you work with somebody who knows what they're doing when it comes to an IFA, and somebody who has the capacity to service you and your business for many years to come. Do not work with somebody who doesn't do IFAs all the time, because there are a lot of moving parts and a lot of things that can go wrong if you don't do it right. So what are some of the legacy and estate planning benefits? One of the biggest reasons that our clients set these up is to use the IFA structure for estate planning. So most of our clients have a growing business, they have other investments, they probably have real estate holdings that are expected to grow over the course of their life. And then what does this mean? It means they're going to have a very large tax bill, aka a very large capital gain, due when they die. So let's say you've got a company today worth $3 million and your house is worth $2 million and your investment portfolio is worth $1 million. So a total of 6. In very simple math, we'll say the whole thing grows at 5% per year until you pass away 30 years from now. So this grows your total net worth to about $21 million, and your estate would have capital gains payable on about 8 million of that. If that happened right now, your estate would have to pay about 50% tax, so 4 million in taxes would be due in that tax year that you die. Do your kids have an extra $4 million kicking around to pay taxes for you? This is obviously a very simplistic example, and I know all the accountants that are watching this have all sorts of planning things they can do to save your taxes and protect your wealth, but this is just to illustrate the point of how quickly and how much tax can become payable during your lifetime. How are your kids or your estate going to come up with an extra $4 million to pay your taxes in that year? So the IFA strategy gives you a large life insurance payout within a couple of weeks of death to pay this giant tax that's due. This IFA strategy and the creation of the capital dividend account, the CDA, which we'll talk about in a minute, also lets you leave a large inheritance to your heirs after all the taxes are paid. So really, when you set up this kind of strategy for yourself and your business and your family, you're guaranteeing a legacy to your family or to whoever you are. And so I just talked about the capital dividend account, or your CDA, right? What is that? CDA is a tax account. It tracks tax-free surpluses in a corporation that's generally created by capital dividends and by life insurance. The money in the CDA can flow to your beneficiaries or to the beneficiaries of your company tax-free. So when your life insurance that we're using in this IFA strategy pays out, it pays to the corporation tax-free, creates the CDA, and then the proceeds are used to pay off any loans to the bank, and then the remainder can be paid out to your company shareholders or to your beneficiaries tax-free. So we would suggest, obviously, that the beneficiaries are your family or your children, but it could be whoever you want. We're going to wrap up because this video is getting to be rather long. We talked about the problems that successful business owners in Canada face in terms of growing their money and using their money without being subject to high tax. We talked about who should and who shouldn't do this strategy, and really how few people in Canada this makes sense for. And then I gave you a quick rundown of, what is an IFA, how does it work, and we talked about why you've probably never heard of this strategy before. And then we talked about the major advantages and the risks of setting up a strategy like this for yourself and for your company, and also what type of advisor you should look for when setting up something like this for yourself. Lastly, we talked about the major legacy and estate planning benefits of setting up a strategy like this for your family, and about how life insurance that pays out to a corporation creates a CDA, capital dividend account, that can be used to pay out to your beneficiaries in a tax-free way. And so now I'm going to emphasize here that you only really want to work with a trusted professional that knows what they're doing and is in it for the long term. And if you're looking at setting up an immediate financing arrangement for yourself. If you want to reach out with questions, you can leave a comment below, or better, go to our website and send us a message at safepacific.com. Those messages come to me and somebody will respond within 24 hours on business days. If you got value from this video today, please click like before you go so that the algorithm knows to show this video to more business owners like you. We're really talking about 1% of Canadians who this strategy is good for, so anything that we can do to help get it in front of such a small group helps. That's it for now. Thanks for watching, and I will see you next time.